Promissory notes. These are the notes that we receive for our accounts. We are going to either have a promissory note for a note payable. That means that it is the note that we are, note payable is what we are, promissory note by a business given to a creditor entered the business books as a note payable. That's what we owe. And notes receivable is what we need to be paid. Most of the time they're just referred to as notes. The maker of the note is a person or business that signs the note. And basically the person that's making the promise to pay. Person who the note is payable to is the payee. The face value is the principal. Interest rate is the amount of rate. The maturity date is when it's due. Term of the note is the number of days or the time. And so here we have the number that's assigned to the note, 6. The date the note is signed. The time of the note, how many days we have to get it paid. The payee, so who you're going to pay. The principal, how much you owe. Your interest rate, and when it's due. You sign it, and if there was a witness. Well, let's look at this first one. On March 18th, we accepted a 90-day note, 8% from Skinner College for the extension of time on his account for $2,578.35. This is note 6. So notes receivable went up by that amount. Accounts receivable went down. So we've now moved it from an accounts receivable to now they are going to have to pay interest, because accounts receivable is usually just pay it by this point. Now we're going to be looking at interest. We're going to have more behind us on it. And the accounts receivable ledger is also going to reduce. So the notes receivable is going to receive the debit. The accounts receivable / Skinner College is going to receive the credit. And remember, we had that diagonal line there because when we post it, we're going to post it to 2 different accounts. The amount paid over the time period is the interest. So we have principal times rate times time equals interest rate for a fractional year. This is not compound interest. This is just basic, simple interest. So we have our principal times the 8% times 90 over 60, 360, which is a quarter of a year. That means the interest rate for that fractional portion of the year is $51.57. The amount due on the maturity date of the note is called the maturity value. And so you'll take your principal plus interest, and that gives you your maturity value. And so to calculate your days, you're going to have to figure out, okay, when does a note start and how many days left in that month. So we started on the 18th and ended on the 31st. That means there's 13 days left in that month. And so I subtract 90 minus 13, that gives me 77. April has 30 days, so 77 minus 30 gives me 47. May has 31. 47 minus 16 gives me 16. And if there's less than a month, you go ahead and write it down and subtract it out. And that's when the 16th is when it's due, because that's when everything's paid off. There's no more days remaining after the 16th. When a note receivable reaches maturity date, the marker of the note is expected to pay the maturity value to the payee. The interest on the money loaned is the interest income. Interest earned on the note receivable is credited to the revenue account titled interest income. And so we had plus interest on this one. So we have a 9-day note with plus interest. So the note receivable is going to get paid off. Cash is going to go up, but the interest income is going to also get paid. So we have 2 different accounts that are going to be credited: interest income and notes receivable. Notes receivable is getting you down to a zero balance if it's one for just that one note, or it's going to reduce it by that amount. And so your cash receipts journal, you have notes receivable and you have your doc number. You get a credit of how much was owed on the loan. And then your second part would be the interest income, and that would receive your interest. The total of these two should amount for the check. The date, the titles, the receipt number came from here. A note that is not paid when it is due is called a dishonored note. And so that means someone did not pay off their debt, they owe interest. So accounts receivable increases, notes receivable decreases, and notes receivable also increase by the amount of the interest. So accounts receivable ledger is going to go up by the amount first out company. And so we have the $3,040 as our debit, and then notes receivable and interest income is going to be credited. So the reason you might delay conditions that might cause business to delay payment to a vendor, it may be insufficient time to pay or money to pay for purchases on expense. What is the advantage of a promissory note over accounts receivable? This is witnessed and it can be used in the court of law as a written evidence of a debt. What does 10% interest rate? What does the interest rate of 10% mean? It means 10 cents on every dollar will be paid for interest from the full year. What is written on the customer's account when A, the note is accepted, and B, the note is dishonored? Accepted note and dishonored note are the two items that can be column on this customer's account. So let's look at doing this. Close out of this and let me open up y'all's assignment. We'll do it together. So in this first one, the calculations. So it starts on the 5th of June. There's 30 days in June, so that gives us 25 days. Subtract that, and that's going to give us 65 days left to pay it off. On the next month, we have 31 days. We subtract and we get 34. Next month, we have 31 days. We subtract, we get 3. So we only have 3 days left, so we can't put more than 3, giving us a 0. So this note, note 3, gives us a principal of $20,000 with an interest rate of 8% for a time period of 90 days. So 90 divided by 360 is a quarter. So we're going to do a quarter of this, and that's going to give us a total amount of $400 that we are going to be adding to our principal to get us our balance. I'm going to pause it and let y'all resume with it all for you to check for the next one. So check your note 4, make sure your data matches. And this one we got $200 in interest because we had a third of a year that was given for this one. And so as we're filling in this chart, it's taking the information from above. So for the 90 day, we had $400 in interest, and for the 120, we had $200 in interest. And then we're going to fill in the maturity date is the date it's going to mature, September 3rd. And October 3rd, or 10th, excuse me. And then how much they promised to pay, and that's going to be the total of this last column. So 20,000 plus 400 is going to be 20,400, and 10,000 plus 200 is 10,200. Now we're going to journalize this information. So we accepted on the 5th of July the 90-day note for an extension of his time on account. And so that's going to be, we have a notes receivable for the 5th of July. And the document number for this is notes receivable 5. And this is going to be the 1,800. It's just moving it out of his accounts receivable. And 1,800. Then we're going to be putting it over in the 26th. We also have Dennis Kraft has dishonored his notes receivable 2 with a 90-day 9% note at 400. So we need to take and adjust his accounts receivable to gain this money. And we're going to, oh, and I forgot to mark that with the person's name. This is for Dennis Kraft. And I forgot to put the accounts receivable / Mary Jane's. I'm looking at the wrong one. From Gary Kennan. Sorry. For extension of his note. And so we had those two. The accounts, the receivable cash is going to go down in cash receipts. I just was doing my two on my general journal, which are going to be the dishonor note and the acceptance of the note. And this is for memo 25. And so we had our principal amount, that's 400, but we also have to figure out how much interest he would have earned in that time period. So we have to do the 400 times your interest rate times the time fractional year, so 90 divided by 360. So 400 times 9% times a quarter of a year is going to get you $9. So this is going to be $409 that he owes us, because he also owes us the interest of the $9. And so notes receivable and interest income are the two credit accounts. Now let's look at the journal for the 12th of July. And this is for, pin this over to the side so we can see it. Mary James, who sent us a check. And so the account title is going to be your notes receivable. And your receipt 113. So receipt 113. And then you're going to have as a credit the 500, because that is how much was done for the loan. And then we have to figure out how much interest. That's the next thing. It's interest income. And so it is 500 times 9% times 60 divided by 360. So 1/6 the year. So 500 times 9% times 1/6 gives me $7.50. And so my cash debit is going to be that total. That's what she wrote the check for, is $507.50. And so now we're going to post all of this. And I'm going to pause it. Posting is very similar to what we've done before. We're taking the information up here and posting it to the individual accounts. I'm going to pause it so you don't have to watch me type it all in, and then y'all can check it in a second. So when we're filling out the posting to the individual accounts, we're going to take from our general journal and our cash receipts. Don't forget to go back and put the account numbers in these spots. And so for Dennis Kraft, we have given him a new balance for his accounts receivable ledger of $409. And for Gary, we have written off his amount that he owes of $1,800 because it's being moved from the notes or accounts receivable, yeah. And so we have that $1,800, it's now being at 0 because we've written it off of there and moved it over to a new one. So accounts receivable, when we look through that entire ledger, we get the credit for the $1,800 and the debit for the $409. And notes receivable is going to get the debit for the $1,800 and then the credits for both the $500 we received and the $400 that was from the dishonored note. The interest income, we're going to still show that same interest income because we're now that $9 is going over into the accounts receivable for him. He has to pay that $9 as well. And so he has the $9 from that. And then we have the $750 that we actually got paid with the money.